Welcome to the Deep Dive. We're here to get you up to speed fast on complex topics. And today we are diving headfirst into a really dynamic space, Indian metals.
Absolutely. And the report we're using today, it just kicks things off with this fantastic title, doesn't it? Rain's over, but peacocks haven't stopped dancing.
Yeah, it's pretty evocative. Tells you a lot straight away, right? That this isn't just some temporary blip.
Exactly. It suggests this. Well, this exuberance in Indian metal stocks has legs. And we're grounding this whole discussion in a pretty heavyweight source. The J.P. Morgan research report on India metals, it's dated October 3rd, 2025, so it's fresh analysis.
Okay, so our job here for you listening is to really cut through the complexity. We want to nail down the key trends driving this dancing. What are the policy triggers, both in India and, globally?
And crucially, how do we make sense of the different outlooks? Because the report isn't bullish on everything. There's a clear split between companies like Tata Steel and JSW versus others like Hindalco and especially the miners.
Right. But first, let's just paint the picture. The performance itself is pretty stark. Nifty metal versus the broader market.
Oh, it's night and day.
Yeah.
Over the last 6 months, you're looking at the Nifty Metal Index up, 20%?
20%.
While the main Nifty Index is lagging behind at maybe 8% growth. So something specific is definitely firing up the metals sector.
Okay, section 1 then. What's the engine behind this? What are these catalysts? So when you see that kind of gap, that 20% versus 8%, you know it's more than just market sentiment. The report points squarely at one main driver, right? This expectation of spread expansion.
That's the term, yeah, spread expansion. And it's really the core idea you need to grasp. The spread is basically the gap between what they sell their metal for, steel, aluminum, whatever, and what it costs them to make it. The raw materials like iron ore, coal.
So wider spread means higher profit margins.
Yep.
Simple enough.
Simple enough, yeah. But the key thing here is why the spread is expected to widen. It's not really because costs are suddenly plummeting. It's much more about government actions, specific policies that are propping up or are expected to prop up the selling prices.
Okay, and these policies are coming from a few different places at once. Let's start with India itself. What's happening domestically?
Well, the big one domestically is the extension of steel safeguard duties. They've been extended for another 3 years.
Right. And these duties, they act like a shield, don't they?
Pretty much. It's an economic shield. It stops cheaper foreign steel flooding the market and undercutting the Indian producers. The report actually notes that Indian hot-rolled coil, HRC, is trading about 10% below the price of imports after duties. So the duties are working. They're holding that price floor.
Okay, so that's the home defense sorted. Then we look overseas. China's policy comes up next, this anti-involution thing. It sounds quite academic. What does it actually mean for metals?
Yeah, it does sound a bit jargony. But anti-involution here basically means China is trying to stop its industries, especially steel, from engaging in this sort of pointless, excessive competition where everyone just chases volume and tanks prices.
So instead of just maximizing tons produced.
Exactly. They're telling their massive steel sector, focus on profitability. For years, the global market kind of suffered because China would just dump steel at low prices to keep their plants running. Now, the signal from Beijing, according to the report, is production cuts, curbing new capacity for 2025, 2026.
And if China, the biggest player by far, starts prioritizing profit over volume?
It supports prices across the whole region. It provides stability. It's a huge structural shift, a real tailwind for Indian steelmakers who compete in that Asian market.
Okay, domestic protection, Chinese discipline. And the third pillar seems to be Europe. This sounds even more direct.
Oh, this is where it gets really interesting. Protectionism, but on steroids almost. The news reports, and J.P. Morgan highlights these, are pointing towards some seriously bullish protectionist moves by the EU.
Like what specifically?
2 main things being floated. First, potentially slashing steel import quotas, maybe by almost half.
Half? Wow.
Yeah. And second, talk of hiking tariffs on steel imports to potentially 50%. 50.
50%. Just to give context, normally you hear about tariffs in the single digits, maybe 10%. 50 sounds less like a tariff and more like a keep-out sign.
It's basically a wall. It makes it incredibly expensive, likely prohibitive, for non-EU steel to enter the market. And if you're a company like Tata Steel with big operations inside Europe, well, that's music to your ears. Margins would just rocket.
Okay, so steel's getting help from multiple angles. What about aluminum? Any policy boosts there?
Yeah, domestically, the recent GST rate cuts in India are mentioned as helpful, particularly for companies selling into the automotive sector. Tata Steel, for instance, apparently has about 20–25% of its product mix going into auto. That's a high-growth, often higher-value segment, so a tax cut there helps demand.
And the currency, that often plays a role in commodities.
Definitely. You can't ignore the FX tailwinds, especially for aluminum guys like Hindalco, Vedanta too. The U.S. dollar has been strong against the Indian rupee.
Right.
And since these companies sell their aluminum on the global market, priced in dollars, but pay a lot of their costs, labor, local supplies in rupees.
A stronger dollar means more rupees for every dollar of sales.
Exactly. It's a nice boost to their rupee-based profits, totally separate from their actual operations. Kind of a free kicker.
So let's recap the policy cocktail. Indian safeguards, China pulling back on volume, potential EU walls, domestic tax cuts, and a helpful exchange rate. It's quite a setup.
It really is, a confluence of factors. And given that, the report makes some pretty clear calls on who benefits most and who doesn't.
Yeah, the preferences seem quite strong.
Unsurprisingly, the top picks are the big steel players, Tata Steel and JSW Steel. They're seen as best plates for this spread expansion.
And on the flip side,
the caution flag is raised for the miners, the guys digging up the raw materials, NMDC for iron ore, and Coal India, least preferred.
Okay, so that sets the scene nicely. It's good to be selling the finished steel right now, maybe less good to be selling the coal or iron ore that goes into it. Let's dig into the winners first. Right, Tata Steel. Clearly a favorite in this report. Price target up to 195 rupees from 180. That's a decent hike. What's driving that confidence? Is it more the domestic story or the international one?
It's really both, working together. That's the key for Tata. Domestically, like we touched on, they're well-positioned. That 20–25% exposure to the auto sector is significant, especially with those GST cuts potentially boosting car sales.
And the safeguard duties give them that price stability at home.
Precisely. It protects their Indian margins from global swings. But then you add the growth potential. The market's apparently buzzing about a potential capacity expansion announcement. The report mentions the Neelachal plant specifically.
So investors are looking at current strength plus future growth plans in India.
Yeah, that signals management sees strong long-term domestic demand. But honestly, the really big narrative, the thing moving the needle significantly for Tata right now, seems to be Europe.
Those potential e-vouchers we discussed, the quota cuts and that massive 50% tariff idea.
Exactly. The report really emphasizes how transformative these could be. Let's just think about that potential price impact again.
Okay.
If those measures come in, the forecast is for European HRC prices to potentially hit 640 euros a ton in the first quarter of calendar 26.
Compared to what now? Around 570?
Yeah, spot price around 570. So you're talking about a price jump of over 10%, maybe 12%, almost overnight, purely because of policy changing the supply dynamics. That flows straight to Tata Europe's bottom line.
And Tata Europe has historically been a bit of a challenge, hasn't it? Profitability issues, utilization rates.
It has. But this potential price surge lands right when Tata is already pushing hard on its own internal fix. They've got this ongoing cost transformation program. The target is to get the UK operations to actually break even on an EBITDA basis by the fourth quarter of fiscal 26.
So the external price lift makes achieving that internal target much easier.
Much easier. And potentially brings profitability forward quite a bit compared to what the market was expecting, just based on cost-cutting alone.
And there's another layer to this European protectionism, isn't there? The CBAM, Carbon Border Adjustment Mechanism. How does that fit in?
Right, CBAM, that's expected to activate, or at least its initial phase, in Q1 fiscal 26 too. Essentially, it's a tax on the carbon footprint of imports.
So it penalizes steel made using, say, high-carbon methods, often outside the EU.
Exactly. It's designed to stop carbon leakage companies just moving dirty production elsewhere. For Tata, if their European operations are relatively cleaner than some potential importers, CBAM acts as another barrier. It makes dirtier steel imports more expensive, further protecting Tata's market. It's like a double whammy of protectionism, trade tariffs, plus carbon tariffs.
And you can see the company feels the pressure from imports currently. They mentioned it on their earnings call, right?
They did. First quarter fiscal 26 call, they talked about imports hitting demand and keeping their UKU capacity utilization down around 60–65%. If these new policies actually cut imports significantly, say by half, like suggested,
that utilization rate shoots up, idle capacity starts making money.
Precisely. Suddenly, those struggling European assets look a whole lot healthier.
Okay, let's switch to the other big steel pick, JSW Steel. Here, the story seems less about fixing overseas issues and more about just sheer domestic power. The price target jump here is even bigger, right?
Mhm.
To 1,250 rupees from 1,100.
Yeah, a very sharp upward revision for JSW. And it's not just the price target. Notice the valuation multiple they're applying.
They bumped it up.
They did, from 7.5 times of EBITDA to 8 times. Now, 8x puts it sort of between the average historical multiple and one standard deviation above average.
So the market's essentially saying JSW deserves a premium valuation now. Why?
Performance. Pure and simple operational outperformance. Look at their production numbers. Fiscal year 26 so far, up to August, their crude steel output is up 16% year on year.
16%. Wow. And the industry average was?
Around 12%. So
Yeah.
JSW is significantly outpacing the market. They are aggressively taking share. It's execution, plain and simple.
And their future plans dwarf even that growth rate. The capacity expansion target is huge.
It's staggering. They're currently around, 35.7 million tons capacity.
Huh?
The plan is to get to 51.5 million tons by fiscal year 2031.
51.5 million tons. That's an enormous bet on India's future.
It is. And that's precisely why the valuation multiple is going up. The core investment idea for JSW, according to this report, is that investors might still be underestimating just how strong and sustained India's domestic steel demand growth will be.
Driven by.
Infrastructure. Everything. Railways, ports, roads, housing, urbanization.
Mhm.
India's building, and building requires steel. JSW is positioning itself to be the dominant supplier for that multi-decade build-out.
And there was also some legal news that helped clear the air for them recently.
Yes, the BPSL resolution plan. The Supreme Court upheld JSW's plan, overturning an earlier decision. That removed a significant legal uncertainty, a kind of overhang that might have worried some investors.
So with that out of the way, the focus is purely on execution and that massive growth story.
Exactly. For JSW, it's less about benefiting from European tariffs and more about riding this powerful wave of Indian domestic demand. They're betting big that India's growth story is real, sticky, and maybe even bigger than people think. If they pull off that 51.5 MT target, they're fundamentally reshaping the industry landscape in India.
Okay, let's pivot now from steel to aluminum. The picture here seems a bit more mixed, especially for companies with big international footprints. It feels like a balancing act.
That's a good way to put it, balancing global headwinds with these strong Indian tailwinds we've been discussing.
Hindalco seems like the poster child for this balancing act. The report keeps a positive view, raising the price target to 810 rupees from 715, but it acknowledges some bumps in the road, particularly for their big U.S. subsidiary, Novelis.
All right, the overall target is up, and interestingly, that's driven by giving the India aluminum business a higher valuation multiple, bumped from 5x to 6 by EBITDA. So the market's recognizing the strength and resilience of the domestic operations.
But the Novelis part, the North American business, is facing some issues. The report mentioned challenges hitting Q2 and Q3 of fiscal 26.
Yeah, unfortunately, they had a couple of specific negative events hit Novelis. There was a fire at their Oswego plant in the U.S., which obviously disrupts production.
Okay.
And then they also saw some production impacts linked to key customers, specifically Jaguar Land Rover, JLR, over in Europe. Novelis makes a lot of specialized aluminum sheet for cars, so if a major customer like JLR slows down, Novelis feels it pretty quickly.
So those two things combined meant analysts had to trim the earnings forecasts for Novelis for the year.
Correct. That's the short-term headwind. Cuts to the FY26 earnings estimates,
Right.
specifically because of those Novelis issues.
But despite that, the overall price target went up. So the strength in India must be pretty significant to offset that.
It appears so. We already talked about the helpful FX rate, dollar strength boosting rupee profits, but beyond that, the report points to genuine structural improvements in the Indian business's profitability.
Structural improvements like what?
They're apparently achieving sustainable gains of at least $200 to $250 per ton. That's a massive improvement.
$200 a ton. Where's
Yeah.
that coming from?
Two main things mentioned. First, securing their own captive coal mines. That drastically cuts their energy costs, which is a huge input for aluminum smelting. Second, they're shifting their product mix towards more complex, higher value-added downstream products. Less basic aluminum ingot, more sophisticated stuff that commands better margins.
And just like with steel, is there a China policy angle supporting global aluminum prices too?
Yes, there is. China has a stated capacity cap for aluminum production, 45 million tons. They're trying to manage supplying in aluminum too, not just steel. That policy discipline from the world's biggest producer helps put a floor under London Metal Exchange, LME, aluminum prices.
Especially if inventories are low.
Exactly. The report notes global aluminum inventories are low, so you have capped supply from China and lean inventories. That's a supportive backdrop for prices.
Okay, so Novelties is expected to recover, but it'll take a bit of time.
The expectation is for improvement coming through in the fourth quarter of fiscal 26. That depends on things like getting better deals on scrap aluminum sourcing, plants running more efficiently as disruptions ease, better operating leverage, and those customer issues hopefully resolving.
Lots to watch there then. Trade deals, premiums.
Yeah, the report flags things like the U.S.-Canada trade deal, how the Midwest premium behaves. That's a key regional price benchmark.
Mm.
And critically, whether Novelties can successfully pass on any cost increases to its big auto customers. That's always key.
All right, let's look at Vedanta. Very different beast. Huge, diversified group. The rating is neutral, but the price target still got a lift to 495 rupees from 450. What's the thinking there?
With Vedanta, the price target bump seems mostly driven by higher price forecasts for the commodities they produce, aluminum, yes, but also zinc, silver. Their strength is that diversification.
Right, they're not just an aluminum play. They're in zinc, lead, silver, oil and gas, iron ore, even steel now.
Exactly. That diversification spreads the risk. A downturn in one commodity might be offset by strength elsewhere. Plus, like Hindalco, they're pushing capacity expansion and vertical integration to lower costs. And the general view is that LME base metal prices should probably trend higher into fiscal 26 and 27, which helps across the board for them.
And they stand out for their dividend potential, too.
Big time. The report highlights Vedanta as having the highest potential dividend yield in the whole group they cover. Forecasted yield for FY26 is around 6.5%.
2.5%. That's pretty chunky.
It is. And for some investors, that high yield is a major attraction, maybe enough to compensate for some of the complexities that come with such a sprawling group.
Ah, the complexities. That brings us to the risks, the things to watch. What are the main ones for Vedanta?
Two big ones highlighted. First, just executing on all those capacity expansion plans. That takes time, capital, and smooth execution. Second, and maybe more immediate, is the whole corporate demerger process they're undergoing.
They're planning to split the company up?
That's the plan.
Yeah.
But the report notes there's been a recent delay in that process, and the concern is that the market might see that delay negatively. It just adds a layer of uncertainty about the future structure and timing. So while the commodity prices look supportive, you've got these company-specific organizational things to keep an eye on.
Okay, we've talked about the steel giants benefiting from policy, the aluminum guys balancing things out. Now let's turn to the cautious side of the report, the miners. Coal India and NMDC. Why the pessimism here when their customers, the steel mills, are doing so well?
It really comes down to that spread idea again, but from the other side. The policies are helping the selling price of the finished metal, but the miners sell the input commodity coal, iron ore, and those prices are often set by different, more global forces. And right now, those forces aren't looking as friendly. Take Coal India. It's tagged as least preferred, rating kept at neutral, price target flat at 420 rupees. The main problem is just sluggish volume.
Not shipping enough coal.
Yeah, the volumes aren't really growing much. Their September 25 numbers were apparently soft, even compared to a relatively easy comparison period last year. And looking ahead, the forecast is pretty muted, maybe 5% average annual growth in production out to fiscal 28. That's not exactly setting the world on fire.
And it's not just volume, it's price, too. The premiums they get are lower.
Right. Their profitability is getting squeezed because the extra price they get in e-auctions, the premium over the base price, has come down compared to fiscal 24.
Why is that happening?
Couple of reasons hitting at once. Globally, international thermal coal prices have been weak. But maybe more importantly, domestically, the power plants in India, coal, India's main customers, are apparently sitting on unusually high stockpiles of coal.
Ah, so if your customers already have bulging warehouses.
They're not desperate to buy more, especially not at high auction premiums. They can afford to wait or buy less. High inventory at the customer end equals pricing pressure for the supplier, Coal India in this case.
So weak volume outlook, pressure on prices. Doesn't sound great. Is there any upside?
Well, the one clear positive, similar to Vedanta actually, is the dividend yield. It's expected to be very attractive, around 7.0% to 7.4% in FY27, FY28.
So it's an income story, maybe?
Potentially, yeah. For investors focused purely on yield, it's interesting. And the company isn't just sitting still, they're increasing their capital spending, specifically trying to improve how they get the coal out, investing in railway links, that sort of thing. So they're trying to address logistical bottlenecks, which could help volumes in the longer run, even if the near-term outlook is soft.
Okay, and the other miner, NMDC, the iron ore producer. This one got the outright underweight rating, the most negative in the report. Price target only nudged up a bit to 67 rupees. What's the issue here?
Well, similar to Coal India, there's a contrast between the near-term and the longer-term view. Near-term, things actually look okay. Their volumes have bounced back after a weak FY25, which was hit by strikes. And because near-term iron ore pricing has been relatively firm, their profit estimates for the next couple of years, FY26 to FY28, have actually been revised up quite significantly, like 12–18%.
So the next year or two might be decent.
Could be, but the underweight rating reflects the worries beyond that, the structural headwinds.
Which are?
The big one is the expectation that international iron ore prices are likely to fall in fiscal 27 and 28. Iron ore prices are very tied to global steel demand, especially China's. If that global picture weakens, iron ore prices tend to follow.
And NMDC doesn't have those safeguard duties protecting it like the steel guys.
Nope. They're much more exposed to global prices. Plus, the report mentions increasing competition both from rising iron ore imports coming into India and from other domestic players ramping up. So potentially falling global prices and rising competition at home. Not a great combination.
And on top of that, they're planning to spend a lot of money.
This seems to be a key concern. Their capital expenditure, CapEx, is set to jump massively. As a percentage of their sales, it's forecast to go from under 12% in FY25 to over 33% other third by FY28.
Wow. Spending a third of your revenue on expansion right when you expect prices to potentially fall.
It looks risky, right? They have a healthy balance sheet now, but pouring that much cash into expansion when the market outlook is cautious? Well, the report suggests it could significantly eat into their net cash position if those lower iron ore prices do materialize in FY27-28. It's aggressive spending into potential weakness.
Okay, let's pull back a bit and tie this all together. We keep coming back to this spread expansion idea being driven by policy. Can we just quickly recap how these global policy shifts really connect back to the profitability of the Indian companies?
Absolutely, because that connection is crucial. The whole bullish case for the steelmakers, Tata and JSW, really hinges on these external policies holding firm.
Let's start with China again, that anti-involution policy. Is it actually working? Are they producing less steel?
The data suggests yes. The report cites figures showing Chinese crude steel output actually fell 3% year over year in the first 8 months of the year, down to about 667 million tons.
3% may not sound huge, but for China's scale,
It's significant, and it signals that the government's push to curb output and focus on profitability in 25 and 26 is real. And like we said, the key behavioral change is Chinese mills reportedly raising export prices. They're not dumping cheap steel anymore.
which supports prices across Asia.
Exactly. It removes that downward pressure that everyone else had to fight against for years. If the biggest player decides to play for margin, not just volume, it lifts the whole market. That's a fundamental support for Tata and JSW's regional pricing.
And then you layer on the European situation, that potential wall of tariffs and quotas. The formal announcement is expected soon.
Yeah, the report mentions expectations around October 7th for a formal European Commission announcement. And the details are striking. These proposed measures, the quota cuts, the 50% tariff talk, they apparently meet the demands of the European Steel Association, EURAFER, and a group of EU member states.
So there's political backing for it.
Seems so. And the scale is what matters, impacting roughly 25% of the EU's steel consumption based on recent import levels. If you suddenly block off or make prohibitively expensive a quarter of the external supply,
Prices inside the EU have to go up.
they almost have to. The report calls it a highly bullish scenario for precisely that reason. It sets up Tata Steel's European arm for a significant margin recovery, driven purely by this protectionist policy.
So you've got China providing a stable floor in Asia, and Europe potentially building a high wall around its own market. It's kind of the perfect storm for producers operating in those regions.
It is. But again, we need to remember this whole thing rests on a solid foundation, which is the demand within India itself. All these global factors amplify the story, but the underlying engine is still strong domestic growth expectations.
Right. The report cited some pretty robust forecasts for Indian steel demand.
Yeah, finished steel demand growth expected at over 11% in fiscal 25, then maybe 7% in 26, 6.5% in 27. Those are strong numbers.
And that's what gives companies like JSW the confidence to target that massive 51.5 million ton capacity they're building for that domestic demand curve.
Exactly. They're not primarily betting on exports. They're betting on India continuing its infrastructure push, its urbanization, its industrial growth. That's the bedrock. The global policies are the very helpful, margin-boosting icing on the cake. Hashtag tag outro. So if we try to boil this all down, what's the key message for you listening to this?
I think the core theme from this deep dive is pretty clear. The Indian metals story right now is powerful because it's got two engines working together.
Engine one being strong domestic fundamentals, that volume growth driven by India's own build-out.
Right. And engine two is this helpful alignment of global policy. China managing supply, Europe potentially restricting imports, which protects and boosts selling prices, domestic volume meets supportive global pricing.
Which creates that spread expansion the analysts are excited about, higher margins.
Exactly. And that leads directly to the main conclusion or preference in the report. A definite tilt towards the big steel producers, Tata and JSW. They capture both the volume growth and the price protection. And conversely, caution on the miners, Coal India and NMDC, because they sell the raw materials whose prices are more exposed to global weakness, and they face issues like high inventories or risky capex plans.
It's really stark contrast, isn't it? The value currently seems skewed towards the companies making the finished product, benefiting from protectionism rather than those digging up the basic commodity input.
It's an unusual situation, definitely.
It is. But maybe let's end with a thought that goes a little beyond the report itself. We've talked about this huge bet on India's future, particularly the massive steel capacity expansion plan targeting something like 247 million tons by fiscal 31. It's all predicated on decades of strong infrastructure spending and growth.
Right, it's a long-term volume play.
It is. So the provocative question, maybe, is what could derail that? Given this enormous capital investment cycle underway, what kind of shock, maybe a major shift in government infrastructure priorities, an unforeseen global event, something not factored into these forecasts, could potentially slow down that relentless domestic demand growth? What could turn some of that massive new capacity, well, into potentially underutilized or stranded assets down the line?
That is a sobering thought. When you're betting the farm on decades of growth, any major disruption becomes a huge risk. Food for thought, indeed. Okay, that brings us to the end of this deep dive. Hopefully you feel well equipped to understand why those peacocks are dancing. Thanks for joining us.